Welcome to the world where money isn't just about numbers, it's about behavior, choices, and the way we see life itself. In this audiobook summary of The Psychology of Money by Morgan Housel, we'll explore the timeless lessons that reveal why financial success is less about what you know, and more about how you think. Through captivating stories and powerful insights, you'll discover why luck and risk play bigger roles than we admit, why our past shapes the way we handle money, and how patience, not brilliance, often determines long-term wealth. We'll uncover the hidden psychology that drives our spending, saving, and investing habits, and why mastering your mindset is the key to mastering your money. Whether you're just starting your financial journey or already deep into it, these lessons will change the way you see wealth forever. So, sit back, relax, and let's dive into the fascinating, unexpected, and deeply human side of money. Introduction. Money isn't just about numbers, charts, or formulas, it's about human behavior. In The Psychology of Money, Morgan Housel takes us on a journey to understand the strange, often irrational ways people think about wealth, greed, and happiness. Through short, insightful stories and timeless lessons, he reveals a simple truth: financial success is less about what you know and more about how you behave. This book isn't a get-rich-quick manual, it's a guide to making better financial decisions by understanding yourself. It explores why two people with the same income can end up with completely different fortunes, why luck and risk play bigger roles than we admit, and why true wealth is more about freedom than material possessions. Housel blends history, psychology, and practical wisdom to show that the hardest part of managing money is not math, it's mastering your own mind. By the end, you'll see that growing wealth isn't just about intelligence, it's about patience, humility, and the ability to stick with a plan through the ups and downs of life. Chapter 1: No One's Crazy. Morgan Housel opens The Psychology of Money by dismantling one of the biggest myths in personal finance, that there's a single, right, way to handle money, and anyone who doesn't follow it is simply irrational or bad with money. This assumption, he explains, is dangerously misleading. The truth is that every financial decision a person makes, whether it's saving, spending, investing, or avoiding the market altogether, comes from a deeply personal place, shaped by the events they've experienced, the environment they've lived in, and the lessons they've absorbed over time. To understand why, Housel invites us to imagine two people. The first grew up in the 1980s and 90s, a period of economic stability, falling interest rates, and a booming stock market. For them, the economy has mostly worked as promised, jobs were plentiful, inflation was tame, and investments tended to rise steadily over the years. They learned, through lived experience, that the market rewards patience and risk-taking. To them, putting money into the stock market is not just logical, it feels safe and reliable. The second person came of age during the Great Depression, or perhaps during the 2008 financial crisis. They may have seen family members lose their homes, watched retirement accounts evaporate overnight, or experienced job losses that took years to recover from. In their world, markets are dangerous, unpredictable beasts. Saving cash under the mattress might feel far more secure than putting money into investments that could crash at any moment. Both people are reacting to reality, their reality. And this is the key insight. What feels like reckless gambling to one person can feel like common sense to another, depending on the world they've lived through. The problem, Housel argues, is that we tend to judge others by our own frame of reference. If we see someone making financial choices we would never make, we instinctively label them as irresponsible, naive, or even foolish. But we forget that our perspective is based on a very small sample size, the events we personally experienced. In truth, nobody has lived through every possible version of the economy. Each of us has only seen a tiny slice of financial history, and we use that limited data set to form our beliefs. If your slice happened to be stable and prosperous, you'll probably lean toward optimism and risk-taking. If your slice was filled with instability and loss, you'll probably lean toward caution and protection. Neither is wrong, they're just different survival strategies for different conditions. Housel pushes this point further by reminding us that even the most logical financial advice, like always invest for the long term or never carry high-interest debt, isn't universal. Logic itself is colored by context. To someone drowning in medical bills, paying off a credit card at 25% interest is the only priority that matters, even if it means missing out on long-term investments. To someone else, maxing out their retirement account before anything else feels like the smart move. The broader lesson here is empathy. Instead of asking, why would they do that, a better question is, what happened in their life that makes this decision feel right to them? When you ask this, you shift from judgment to understanding. You begin to see that money is not just a math problem, it's a deeply emotional, personal reflection of the battles people have fought and the fears they've learned to avoid. By the end of this chapter, Housel leaves us with a powerful takeaway. No one is truly crazy with money. Everyone is simply playing the game as they've been taught to play it, based on the cards life dealt them. If we can understand this, we can approach conversations about money with more compassion, less arrogance, and a greater awareness that there's no single, correct, path to financial well-being. Money, after all, is not just about numbers and spreadsheets. It's about trust. It's about fear. It's about survival. And above all, it's about the story each person carries with them. Chapter 2, Luck and Risk. Morgan Housel begins Chapter 2 with a humbling truth: success and failure in money are never entirely the result of skill or stupidity, luck and risk play much bigger roles than we often acknowledge. To illustrate, he opens with the story of Bill Gates. Gates attended one of the only high schools in the world that had a computer in 1968, Lakeside School in Seattle. This rare access to technology at such a young age set him on the path to founding Microsoft. Gates himself acknowledges this was an extraordinary stroke of luck. But Housel contrasts this with the story of Kent Evans, one of Gates' closest friends and one of the smartest, most promising young men Gates knew. Tragically, Evans died in a mountaineering accident before he could achieve any of his potential. Same school, same opportunities, same brilliance, one became one of the richest people in the world, the other never got the chance. This contrast drives home the chapter's point: outcomes in life, and especially in finance, are often shaped by factors completely outside our control. Luck is when random forces work in our favor, risk is when those same forces work against us. Both are always present, and neither can be eliminated. Housel explains that we often fall into a dangerous mental trap: when someone becomes wildly successful, we're tempted to dissect their decisions as if copying them will guarantee the same results. We overlook the possibility that timing, chance meetings, or random market conditions were critical to their success. Likewise, when someone fails, we tend to assume they made bad decisions, ignoring the fact that bad luck, like a sudden illness, an unexpected recession, or an accident, might have been the real cause. In money, this means two things. 1. Be careful about drawing hard lessons from other people's successes or failures. You can copy someone's actions exactly and still end up with completely different results because you won't have the exact same luck they had, or avoided the exact same risks they dodged. 2. Never let a single lucky win convince you you're invincible, and never let one unlucky break convince you you're doomed. Housel offers a practical takeaway: focus less on extreme outliers, those rare cases of massive wealth or devastating ruin, and more on broad patterns that work most of the time. Luck and risk will always swing the results, but sound habits and conservative planning can help you survive the bad swings and be ready for the good ones. By the end of the chapter, you're left with a humbling but freeing perspective: money isn't a perfectly predictable game of cause and effect. It's a mixture of skill, behavior, and forces beyond your control. The smartest approach isn't to chase certainty, it's to respect uncertainty. That means preparing for a range of outcomes, never assuming you're untouchable, and showing empathy for both the winners and the losers, because behind every financial story, there's always an unseen thread of luck and risk shaping the outcome. Chapter 3, Never Enough. Morgan Housel opens this chapter with one of the most striking cautionary tales in financial history, a story that perfectly captures the idea of never enough. He tells us about Rajat Gupta, a man who seemingly had it all. Born in Kolkata, India, Gupta lost both of his parents as a teenager, yet he rose to extraordinary heights. He graduated from the Indian Institute of Technology, earned his MBA from Harvard Business School, and eventually became the managing director of McKinsey & Company, the most prestigious consulting firm in the world. He was wealthy, respected, and connected to some of the most powerful people on the planet. By 2008, Gupta's net worth was estimated at over $100 million. He had everything most people could ever dream of: financial security for generations, a stellar reputation, and influence at the highest levels of business and politics. Yet, during the financial crisis, Gupta got involved in insider trading, passing confidential information to hedge fund billionaire Raj Rajaratnam. Why would a man who already had so much risk it all for a little more? The answer, Housel explains, is that Gupta's benchmark for enough kept moving. In his social circles, being worth $100 million wasn't impressive, it was small compared to billionaires. He wasn't poor, but compared to the people he interacted with daily, he might have felt like he was falling behind. Gupta was eventually caught, charged, and sentenced to prison. His legacy, built over decades, was destroyed in an instant. And for what? A little more money he didn't need. Housel uses this story to highlight one of the most dangerous forces in finance: the inability to recognize when you have enough. The moment enough disappears from your vocabulary, you become vulnerable to taking bigger and bigger risks that can wipe you out. He then contrasts Gupta's downfall with the story of Warren Buffett. Buffett, despite being worth tens of billions of dollars, lives in the same modest house he bought in 1958. He could easily afford multiple mansions, private islands, or yachts, but he doesn't need them. Buffett understands that real wealth isn't about having more, it's about having control over your time, your choices, and your peace of mind. The lesson is simple but profound. Enough is a decision, not a number. No matter how much you have, there will always be someone richer, more successful, or with more toys. If your sense of satisfaction depends on catching up to them, you'll never feel content. The game changes once you win. If you've reached a point where your needs are met, taking extra risks for marginal gains can destroy everything you've built. Housel warns that envy is a silent wealth killer. Social comparison pushes people to overextend, overleverage, and overinvest in risky ventures just to keep up. In the modern world, this pressure is amplified by social media, where we're constantly bombarded with images of lifestyles far beyond our own. The problem is, those images rarely show the full picture: the debt, the stress, the trade-offs behind the scenes. He leaves us with this powerful takeaway: the hardest financial skill is getting the goalpost to stop moving. True wealth is not measured by the size of your bank account, it's measured by the contentment you feel with what you already have. Once you realize you have enough, you're free from the endless chase. By the end of the chapter, you understand that more money won't always solve your problems, sometimes, it creates new ones. The real challenge isn't earning more, it's knowing when to stop. Chapter 4, Confounding Compounding. Morgan Housel begins this chapter with a story so mind-bending it almost sounds like fiction. He talks about Warren Buffett, but instead of focusing on Buffett's stock-picking genius, he draws attention to something far more ordinary, and yet far more powerful: time. Buffett is one of the richest men in the world, with a fortune exceeding $80 billion at the time Housel wrote the book. But here's the surprising part: more than $70 billion of that wealth came after Buffett turned 60. If he had started investing in his 30s instead of as a child, most people might never have heard of him. His skill is impressive, but his secret weapon is that he's been investing consistently for over 75 years. Housel puts it plainly: compounding is deceptively simple but absurdly powerful. The problem is, our brains aren't wired to grasp exponential growth intuitively. We're used to thinking in straight lines, additive growth, where results move at a steady pace. Compounding, however, is like pushing a snowball down a hill. At first, it's small and unimpressive, but as time passes, it grows faster and faster, feeding on its own growth. To show this, Housel gives a thought experiment. Imagine a tiny amount of money, say, $81.50, growing at 50% per year. After 1 year, it's $122.25. Nothing exciting. But keep that growth going for 75 years, and it turns into more than $81 billion. The math feels magical because we aren't built to think this way naturally. Housel also warns that people tend to look at Buffett and think, I just need his investing skill. But skill is only part of the equation. Many other investors may have been just as talented, or even better, but they didn't sustain their performance for decades. They quit, they burned out, they took huge risks and lost big, or they simply started too late. Compounding doesn't require extreme intelligence, it requires patience and consistency. That's the hard part. Most of us want results quickly. We change strategies too soon, panic when markets drop, or take unnecessary risks to accelerate our gains. Each of these mistakes interrupts compounding, and when you interrupt compounding, you destroy its magic. He makes an important observation: compounding doesn't just apply to money, it applies to relationships, knowledge, reputation, and even health. A small act of kindness repeated daily compounds into trust and deep friendships. Reading for 30 minutes a day compounds into a wealth of knowledge. Small healthy habits compound into a stronger body over decades. Housel's key takeaway: good investing isn't about making the best returns, it's about making pretty good returns for the longest period of time possible. You don't have to hit home runs, you just need to avoid striking out and stay in the game long enough for compounding to work its magic. He closes the chapter with an analogy: compounding is like planting a tree. The best day to plant was decades ago, but the second best day is today. Once it's in the ground, your job isn't to dig it up to check the roots, it's to water it, protect it, and give it time. The longer you let it grow, the more shade it provides, and the stronger it becomes against storms. By the end, you realize that wealth creation isn't about brilliance, it's about endurance. And endurance comes from humility, patience, and the ability to delay gratification for years, even decades. Chapter 5: Getting Wealthy versus Staying Wealthy. When we think of wealth, we often picture the climb, the grind, the hustle, the bold risk someone took to make it big. We imagine the dramatic rise, the moment someone turns nothing into something. But Morgan Housel reminds us that there are actually two very different skills in the game of money: getting wealthy and staying wealthy. And the truth is, they require almost opposite mindsets. Getting wealthy often demands optimism, boldness, and risk-taking. You have to believe that your ideas will work, that opportunities will pay off, and sometimes, you must be willing to put yourself out there when the odds are unclear. Entrepreneurs, investors, and innovators often ride on a wave of confidence, sometimes even overconfidence, to make that initial fortune. But once you have wealth, the game changes entirely. Now, the mission isn't to conquer new territory, it's to protect what you've built. Staying wealthy demands humility, paranoia, and a deep respect for risk. You have to constantly ask yourself, what could go wrong? What risks am I not seeing? It's no longer about chasing the next big thing at all costs, it's about not losing the empire you've worked so hard to build. Housel makes a striking point: the same traits that help you get rich, aggression, big bets, bold moves, can be the very traits that make you lose it all. Think about lottery winners, athletes, or entrepreneurs who rocket to success and then, within years, fall back to nothing. Often, it's not because they didn't know how to make money, it's because they never switched gears to keeping it. He uses a phrase that really sticks: survival is the key to compounding. Compounding, the magic of money growing over time, only works if you stay in the game long enough. And staying in the game requires a survival mindset. You can't compound what you lose. That's why Housel emphasizes room for error in every financial decision. This means having buffers, extra cash, diversified investments, backup plans, so you're not knocked out of the game when the unexpected happens. Because the unexpected will happen. Economic crashes, pandemics, sudden job loss, personal emergencies, these events are inevitable over a lifetime. The people who endure aren't the ones who predict them perfectly, they're the ones who are financially prepared to absorb the shock. He also points to an often overlooked quality in long-term wealth: knowing when to stop. It's human nature to keep pushing, to keep chasing bigger numbers, thinking, just a little more. But that endless chase often leads to bigger risks, riskier bets, and eventually, loss. The people who protect their fortunes are often the ones who know when enough is enough. So here's the big takeaway from this chapter. Getting rich is a sprint. Staying rich is a marathon. The sprint rewards speed, boldness, and belief. The marathon rewards patience, caution, and humility. And if you want to win the money game for life, you have to master both. In Housel's words, be optimistic enough to take chances, but paranoid enough to survive the ones that go wrong. Chapter 6, Tails, You Win. Life, money, and success are not evenly distributed. In fact, Morgan Housel points out something that sounds almost unfair: most of the rewards in life come from a tiny fraction of events. This is the idea behind tails. In statistics, a tail refers to the rare, extreme events that sit far away from the average on a graph. And in the real world, those tails often account for the majority of our results. It's the handful of big wins, lucky breaks, or rare opportunities that make the most difference. Think about investing. If you owned stock in Amazon in the late 1990s and held onto it for decades, just that one decision could have made you millions. Out of thousands of potential investments, it's the single big winner, the outlier, that makes all the difference. This isn't just true in finance, it's true in business, careers, even relationships. Housel gives striking examples. Most of Warren Buffett's enormous fortune comes from just a small number of investments he's made in his lifetime. Out of hundreds of business ideas, the vast majority barely moved the needle, but the rare, tail, investments, like Coca-Cola, Apple, changed everything. The lesson here is that you don't have to be right all the time. You don't need every decision to be perfect. In fact, you can be wrong a lot, as long as you stick around long enough to catch a tail event when it happens. But there's a catch: you only benefit from tails if you stay in the game long enough to see them. This means avoiding decisions that can wipe you out completely. If you gamble too much or take reckless risks, you might never get to the point where the rare win shows up. Another powerful point Housel makes is about our tendency to underestimate how much luck plays a role in tails. Sometimes, being in the right place at the right time matters more than skill. Jeff Bezos wasn't the only person trying to sell books online in the 1990s, but he happened to make the right moves at the right time, in the right market, and the rest became history. This doesn't mean we should sit around waiting for luck to save us. Instead, Housel suggests positioning yourself so that when a tail opportunity appears, you're ready to grab it. That means trying many things, experimenting, and not giving up too soon just because most attempts fail. Here's the mental shift: don't judge success by how often you're right, judge it by whether you can capture the rare, massive wins. In money, as in life, the scoreboard is tilted. The small number of events that matter most will often be invisible until they've already happened. But if you protect yourself from ruin, keep showing up, and take enough shots, eventually you'll hit a tail. And when you do, it can make up for every small loss, every false start, every failure along the way. Tails don't just help you win, they can change your life. Chapter 7, Freedom. If you ask people what money means to them, you'll hear 1,000 different answers. For some, it's luxury, a big house, an expensive car, exotic vacations. For others, it's security, knowing the bills will be paid, that emergencies won't destroy them financially. But Morgan Housel points out something more powerful than all of that. The highest form of wealth isn't owning things, it's owning your time. Think about it. You can have millions in the bank, but if you wake up every morning dreading your schedule, answering to people you don't respect, and spending your days doing things you hate, are you really rich? Or are you just well decorated in your own cage? True freedom is being able to wake up and say, "What do I want to do today?" And actually mean it. Housel shares that many people chase money thinking it will lead to freedom, but they get trapped in a cycle where they spend more as they earn more. The bigger the income, the bigger the lifestyle, and the bigger the obligations needed to keep that lifestyle going. They end up with golden handcuffs. Beautiful. Shiny. But still handcuffs. Here's the paradox: freedom costs less than you think. You don't need infinite wealth to own your time, you just need enough so that your basic needs are met, you're free from high-interest debt, and you have a cushion that allows you to say no to things that drain you. Consider this example. Two people both earn $100,000 a year. One spends $95,000 keeping up appearances, nice car, designer clothes, dining out constantly. The other spends $50,000, saves the rest, and builds a safety net. Who's richer? On paper, they earn the same. In reality, the second person has options: they can take a break, change careers, work fewer hours. The first is stuck running just to stay in place. Freedom is also deeply personal. For some, it might mean taking 6 months off to travel. For others, it's working from home, picking your kids up from school every day, or having a 4-day workweek. The form doesn't matter, the ability to choose does. The problem is, we often trade that ability away for status. We say yes to every opportunity, every project, every demand on our time, without realizing we're selling off little pieces of our freedom in exchange for money we may not even need. Housel's advice is simple but profound: don't just aim to get rich, aim to stay free. This means building a financial life where you control the majority of your time. It might mean earning less than you're capable of, but in exchange, you're wealthier in hours, days, and peace of mind. Because here's the truth: people rarely regret having less money, but they often regret losing the years they could have spent living life on their terms. Money buys many things, but its most valuable purchase is the right to decide what to do with your time. That's real wealth. That's real freedom. Chapter 8: The Man in the Car Paradox. You've probably seen it before: someone driving past in a sleek, expensive car, and for a split second, you think, wow, they must be successful. But here's the twist Morgan Housel calls the man in the car paradox: when we see someone with an expensive car, we don't actually think about them. We imagine ourselves in the car. We think about how we would look in it. We project our own fantasy onto the scene. And that means the admiration the owner thinks they're receiving isn't really for them at all. Most people believe that owning luxury items will make others respect them, envy them, or even want to be them. But the truth is, almost no one is thinking about the driver. They're thinking about themselves. Housel explains that this is why chasing status through possessions often feels hollow. People might notice your car, your watch, your designer suit, but their attention is fleeting, and it's self-centered. They're not deeply impressed with you, they're imagining how much better their life would be if they had the same thing. It's a sobering realization. That $100,000 car might turn heads for a moment, but it won't buy you the lasting admiration you're secretly hoping for. And yet, so many people go deep into debt, lock themselves into long work hours, and sacrifice time, freedom, and peace of mind, all to buy things they think will make them more likable. But here's the real paradox: the things that actually make people admire you, kindness, competence, reliability, confidence, can't be bought. They have to be lived. If you truly want respect, it's better to focus on who you are rather than what you own. People will remember how you treat them far longer than they'll remember the brand of your car. This doesn't mean you can't enjoy nice things. Housel isn't against luxury. He's against mistaking luxury for respect. If you buy the car because you love the engineering, the feel of the drive, the joy it brings you, great. But if you buy it because you think it will make people think more of you, you're probably falling into the trap. The key is self-awareness. Before you make a big purchase, ask yourself, am I buying this because it genuinely adds value to my life, or because I want other people to see me a certain way? That simple question can save you years of financial stress and disappointment. In the end, the man in the car is a reminder: admiration doesn't come from the object, it comes from the person. You can spend your life chasing the image of success, or you can quietly build a life so rich in character that you don't need to flash anything to feel valuable. Because when you realize people aren't thinking about you nearly as much as you think they are, you're free to stop performing and start living. Chapter 9, Wealth is What You Don't See. When you see a luxury car glide past you on the street, you're looking at spending, not wealth. That's the hidden truth Morgan Housel drives home in this chapter. Wealth is invisible. It's the money that hasn't been spent. The investments quietly compounding. The savings growing silently in an account you'll never post on Instagram. The world teaches us to measure success by what we can see. Big houses, designer clothes, first-class flights, vacation photos. But these are all signs of money that has already left someone's bank account. It's gone. It's no longer wealth, it's consumption. The real financial strength, Housel says, is almost always silent. You can't see the $1 million index fund a neighbor has been quietly contributing to for 20 years. You can't see the fully paid-off house that means a family sleeps peacefully at night with zero debt. You can't see the freedom someone has to walk away from a toxic job because they've built a cushion. The irony? The people with the most actual wealth often look ordinary. They don't feel the need to constantly prove it. They're not emptying their accounts to impress strangers. They understand that the richest signal they can send to themselves isn't a luxury purchase, it's the security, independence, and opportunities that only unspent money can provide. It's easy to forget this because our culture rewards visibility. We admire what we can point at, post about, and show off. And so, we end up assuming that if someone lives modestly, they must not be wealthy. But more often than not, the opposite is true. The modest lifestyle is exactly what allowed them to become wealthy in the first place. Think about it this way, if you want to grow a tree, you don't keep plucking the fruit the second it appears, you let it grow, you let it multiply. Wealth works the same way. Spending down every dollar as soon as you earn it is like cutting branches before they bear fruit. This is why the financially wise avoid equating rich with wealthy. Rich is a momentary state. You can be rich today and broke tomorrow. Wealth is endurance. Wealth is the quiet, long-term ability to control your time and your future. And here's the liberating part, you don't need to look wealthy to be wealthy. You don't need validation through other people's eyes. In fact, the less you care about impressing others, the more likely you are to build lasting wealth, because you're no longer pouring your resources into buying status you don't need. So, the next time you're tempted to spend for show, pause and ask yourself, do I want to look rich today, or do I want to be wealthy tomorrow? Because real wealth isn't the car in the driveway. It's the unseen safety net that ensures you'll never have to sell that car just to pay the bills. Chapter 10, Save Money. If there's one habit that separates those who build lasting wealth from those who only dream about it, it's this: they save, relentlessly. It sounds simple, even boring. Save money doesn't have the sparkle of invest in the next big thing or launch a billion-dollar startup. But the truth? Savings are the foundation of every financial success story. Without it, there's nothing to invest, nothing to build on, no cushion when life inevitably throws a storm your way. Morgan Housel puts it plainly, your savings rate matters far more than your income or investment returns in the beginning. Why? Because savings are within your control. You can't always dictate the stock market's performance, or the interest rate your bank offers, or how quickly your career will advance. But you can choose how much you keep. The magic of saving money is that it works in all environments. When the economy is booming, savings let you seize opportunities, buying undervalued assets, starting a business, or upgrading your life without going into debt. When the economy tanks, savings act as your lifeline, protecting you from panic selling investments or being forced into desperate decisions. And here's the part that most people underestimate, saving is less about mathematics and more about psychology. It's not about knowing the perfect percentage to save, it's about living a lifestyle where you consistently spend less than you earn. It's about learning to want less. You can live in a small apartment and still feel rich if your bills are low, your stress is minimal, and your bank account is growing. On the flip side, you can live in a mansion and still feel trapped if every dollar is spoken for before you even earn it. Wealth is freedom, and savings are the ticket. Housel also reminds us that saving isn't just for retirement or emergencies, it's for options. The option to quit a toxic job. The option to travel. The option to take time off to be with your family. The option to take a risk without worrying it will ruin you. Every dollar saved is a vote for future freedom. The best part? You don't need a massive salary to start. Many of the world's quietly wealthy people began with modest incomes but high savings rates. They simply avoided lifestyle inflation, refusing to let every raise or bonus instantly inflate their spending. Saving isn't glamorous. No one will applaud you for skipping that new car or saying no to a trendy vacation. But in 10 years, when you have enough money to live life on your terms, you'll be grateful for every boring, invisible dollar you kept. And remember, you can't save what you spend to impress others. The less you care about what other people think, the easier saving becomes. So start small if you have to. Save $50. Then $100. Then more. Make it automatic. Make it non-negotiable. Because when you save consistently, you're not just putting away money, you're buying yourself time, control, and peace of mind. In the end, savings are like oxygen. You don't notice them when you have enough. But the moment they run out, nothing else matters. Chapter 11, Reasonable to Rational. In traditional finance theory, people are expected to make decisions that are perfectly rational, decisions based purely on numbers, probabilities, and mathematical optimization. But Morgan Housel points out that real life doesn't work that way. We aren't robots. We have emotions, fears, hopes, and life circumstances that make perfectly rational decisions impractical, or even impossible. Housel argues that in the real world, it's often better to aim for reasonable financial decisions rather than perfectly rational ones. A reasonable decision is one you can stick to, sleep with, and feel comfortable living with, even if it's not technically the most mathematically optimal choice. He gives examples. A perfectly rational investor might put all their money into a single high-return asset class to maximize long-term gains. But that's risky and emotionally exhausting. A reasonable investor might accept slightly lower returns in exchange for diversification, which makes it easier to stay invested through market downturns. Mathematically, it may be rational to invest heavily in stocks and almost nothing in bonds if you have decades ahead, but if the stock market plunges 50% and you panic, sell, and never return, the rational choice becomes disastrous. Housel emphasizes that staying the course matters more than squeezing out every last drop of return. The biggest enemy of long-term wealth isn't under-optimization, it's abandoning your plan because you couldn't handle the emotional strain. He also points out that what's reasonable for one person may not be reasonable for another. For instance, a retired person living off savings will naturally make more conservative choices than a 25-year-old with decades to recover from losses. Neither is wrong, they're just responding to different realities. The heart of the chapter is this. Money decisions aren't made in spreadsheets, they're made at dinner tables, in late-night conversations, and in moments of stress or excitement. You don't have to be perfect, you have to be consistent. A strategy you can live with in bad times is infinitely better than a perfect plan you abandon when things get rough. In other words, reasonable beats rational because it keeps you in the game. And staying in the game is the only way to let time and compounding work their magic. Chapter 12, Surprise. Morgan Housel begins this chapter with a simple but uncomfortable truth: the most important events in history, financial or otherwise, are often the ones nobody saw coming. The surprise factor is a reminder that the future is inherently unpredictable, and our biggest risks and opportunities usually come from things outside the scope of our imagination. He explains that we tend to base our expectations of the future on our personal experiences or recent history. If inflation has been low for decades, we assume it will always be low. If the stock market has gone up for years, we expect that trend to continue. But history shows that reality doesn't move in straight lines, game-changing events appear suddenly, and they rewrite the rules. Housel uses examples like September 11, 2001, few people predicted how a terrorist attack could instantly change global politics, security, and even economic patterns. The 2008 financial crisis, even though there were warning signs, the scale and timing of the collapse blindsided most experts. COVID-19, practically no investor's 2019 portfolio plan included the idea of a global pandemic shutting down entire economies for months. These events didn't just surprise, they completely altered the playing field for everyone involved. The lesson isn't that we should try harder to predict these rare shocks, because by nature, they're unpredictable. Instead, Housel says we should expect surprises as a normal part of life and finance. Rather than trying to foresee the exact event, we should prepare for the reality that something unexpected will happen. That means 1. Building flexibility into your financial plan so you can adapt when the unexpected hits. 2. Avoiding overconfidence in forecasts, accepting that even the smartest analysts will miss the biggest shifts. 3. Keeping a margin of safety, extra cash, low debt, diversified investments, so a surprise doesn't wipe you out. Housel also makes a subtle but important point: surprises aren't always bad. Just as crises appear out of nowhere, so do opportunities. Many of history's biggest fortunes were made by people who were ready to take advantage of sudden, unpredictable events. For example, companies like Netflix and Zoom thrived because they were positioned to serve a need that skyrocketed during the pandemic. Ultimately, the chapter drives home that the best approach to money isn't about perfect prediction, it's about resilience. The goal is to stay in the game no matter what surprises come your way. If you can survive the unexpected, you're in a position to benefit from it when the tides turn in your favor. Housel's closing thought is almost philosophical: we tend to view history as a series of inevitable steps leading to today, but in reality, it's a chaotic mix of accidents, coincidences, and shocks. The only thing we should expect with certainty is that we'll be surprised again, and again. Chapter 13, Room for Error. Morgan Housel opens this chapter with a principle that runs through every part of smart money management: always leave yourself a margin of safety. No matter how confident you are in a plan, life has a way of humbling even the best forecasters. Room for error is what allows you to stay standing when the unexpected happens. He draws a clear distinction between being right and surviving long enough to be right. You can make smart investments, set reasonable goals, and do all the right things. But if your plan leaves no buffer for bad luck, even one unexpected setback can undo years of progress. Why a margin of safety matters. The future is uncertain, you will be wrong about something. The margin gives you space to be wrong and still be okay. Black swan events exist, rare but devastating surprises, like economic collapses or natural disasters, can knock you off course completely. Human error is inevitable, even with good intentions and research, we all make mistakes. Housel gives practical examples of building room for error. In investing, diversify your portfolio so that if one part fails, others can keep you afloat. Don't invest so aggressively that a market downturn forces you to sell at a loss. In personal finance, keep an emergency fund, cash reserves that can cover months of expenses in case of job loss, medical emergencies, or other shocks. In decision-making, make plans assuming things will take longer, cost more, and be harder than expected. He also warns against optimizing too much. Many people build financial plans assuming the absolute best-case scenario: markets will always go up, income will always rise, opportunities will always be there. But the closer you cut it, the less room you have to maneuver when life doesn't cooperate. Housel compares it to driving: if you take a corner at the maximum speed your car can handle, you have zero margin for error, any small slip, and you crash. But if you slow down just a bit, you have space to recover if something goes wrong. The big takeaway is that survival trumps perfection. You don't have to win every bet or time every decision perfectly, you just have to avoid ruin. In money, as in life, staying in the game is what allows compounding to work its magic over decades. Housel closes by emphasizing that people often underestimate how fragile success can be. The ability to absorb shocks, whether financial, personal, or professional, isn't a luxury. It's the very foundation of lasting wealth. Chapter 14, You'll Change. Morgan Housel begins this chapter with a humbling reality: who you are today is not who you'll be in 10 or 20 years. Your goals, desires, values, and even your definition of success will evolve over time, often in ways you can't predict. This means that financial decisions made with today's mindset might not match what your future self truly wants. He introduces the concept of the end of history illusion, the psychological bias where people recognize that they've changed a lot in the past, but assume they'll stay the same going forward. The problem is, this assumption makes us set long-term plans that may not fit the person we become. Examples of change over time. At 25, you might prioritize career growth and be willing to work long hours. At 45, you might value time with family more than climbing the corporate ladder. You might dream of retiring early to travel the world, only to find that in retirement you crave stability and community instead. Your risk tolerance may shift. Aggressive investing in your youth might feel exciting, but decades later, you may prefer safety and certainty. Housel's advice is to build flexibility into your financial life. Instead of locking yourself into rigid, irreversible plans, create strategies that allow you to pivot as your priorities change. For instance, save more than you think you'll need. Extra savings give you the freedom to adapt without starting over. Avoid overcommitting to a lifestyle that requires everything to go perfectly for decades. Invest in ways that allow liquidity and optionality, rather than tying up all your wealth in assets you can't easily change. He stresses that changing your mind isn't failure, it's growth. The danger is when people cling to outdated goals out of pride or the fear of wasting past effort. In reality, it's better to accept sunk costs and adjust than to keep pursuing something that no longer fits your life. Housel closes the chapter with a simple truth: the most important financial skill may be humility, the humility to admit that you don't know exactly what you'll want in the future. Your job is not to predict your future self perfectly, but to give them the resources, freedom, and flexibility to live well, whatever living well means to them at that point in life. Chapter 15, Nothing's Free. In this chapter, Morgan Housel explores a truth we often try to avoid: everything in life has a price, whether you pay for it with money, time, energy, or peace of mind. There's no such thing as a completely free reward. Every gain demands a cost, sometimes upfront, sometimes later, but it's always there. He begins by talking about the hidden cost of wealth. You might think the price of getting rich is just working hard or making smart investments, but it's more than that. The real cost can be stress, uncertainty, sleepless nights, and the constant emotional ups and downs of the market. In other words, volatility is the price tag of big long-term returns. If you want the rewards of investing, you have to be willing to endure the uncomfortable moments along the way. Housel compares this to going to Disneyland. Tickets are expensive, but if you love the experience, you don't view the price as a penalty, you see it as a fee worth paying. The same applies to investing. Market downturns, scary headlines, and temporary losses aren't penalties, they're the fees for the privilege of building wealth over time. Unfortunately, most people try to avoid paying this fee, pulling out of the market when things get tough, and in doing so, they also avoid the rewards. He also emphasizes the importance of reframing your mindset about these costs. If you see them as unfair punishments, you'll resent the process and quit early. But if you see them as part of the natural price of admission, you'll stay the course. That shift in perspective can make the difference between giving up and building real, lasting wealth. Finally, Housel reminds us that the best things in life, financial security, freedom, and peace of mind, aren't free. The question isn't whether you'll pay for them, but whether you're willing to pay the right price, for the right reward, for long enough to reap the benefits. Chapter 16, You and Me. In The Psychology of Money, Chapter 16, You and Me, Morgan Housel explores a subtle but profoundly important truth. People make financial decisions based on their own personal circumstances, goals, and life experiences, and those can be radically different from yours. Think about it: the stock market, housing, savings, spending, these things aren't experienced in a vacuum. They're experienced through the lens of your age, your income, your family situation, your fears, and your aspirations. That's why two intelligent people can look at the exact same investment opportunity and make opposite decisions, and both can be right in their own context. Housel explains that the financial world is filled with noise, not because people are irrational, but because everyone is playing a different game. For example, a 25-year-old tech worker might see a stock market dip as an exciting buying opportunity. A 65-year-old retiree, living off savings, might see that same dip as a terrifying threat to their lifestyle. The data is the same. The reality? Completely different. This chapter warns against the dangerous habit of blindly following someone else's advice without understanding the game they're playing. A day trader and a long-term index investor might both be in the stock market, but their rules, risks, and timelines are worlds apart. Housel urges us to recognize that what works for someone else might not be right for you, and what's right for you might make no sense to someone else. Understanding this removes the pressure to constantly compare your financial path to others. In short, Chapter 16 is a reminder that money decisions are not universally correct or wrong. They are deeply personal strategies shaped by individual lives. The real skill isn't copying what someone else does, it's knowing your own game and playing it well. Chapter 17, The Seduction of Pessimism. Pessimism has a strange hold over us. It grabs our attention more fiercely than optimism ever could. Why? Because pessimism sounds smarter, more realistic, even when it's just as speculative as optimism. In The Psychology of Money, Morgan Housel explains that people are naturally drawn to negative predictions because they feel like warnings, and warnings give us a sense of control. If we prepare for the worst, maybe we can avoid it. But here's the twist: while bad things can happen suddenly and dramatically, good things tend to happen slowly and quietly. Economic growth, innovation, wealth creation, all of these are gradual processes, often so slow you barely notice them. Meanwhile, disasters are loud and immediate. This imbalance tricks our perception. We see market crashes as signs of doom, forgetting that throughout history, markets have recovered and grown over the long term. Housel also points out that pessimism often disguises itself as wisdom. Someone predicting a crash sounds like a careful thinker, while someone predicting long-term growth can be brushed off as naive. Yet, in reality, the world has consistently improved over decades, despite short-term chaos. The optimist may seem less sophisticated, but statistically, they're more likely to be right in the long run. The key takeaway: don't let pessimism dominate your financial decisions. It's tempting to pull out of investments when headlines scream disaster, but doing so can rob you of the long-term compounding that truly builds wealth. The smartest investors acknowledge that setbacks happen, but they also remember that the long-term trajectory of human progress is upward. In short, while it's good to be cautious, you can't let fear be your main guide. The future will have problems, yes, but it will also have solutions, innovations, and opportunities. And those who keep their faith in the bigger picture tend to come out ahead. Chapter 18, When You'll Believe Anything. In the final chapter of The Psychology of Money, Morgan Housel dives into one of the most fascinating, and often overlooked, aspects of financial behavior: our willingness to believe certain stories, even when they don't make perfect sense. And the truth is, in the world of money, people don't just deal with facts, they deal with narratives. Housel explains that money isn't purely about numbers or logic, it's about stories that feel emotionally true to us. We often adopt financial beliefs not because they're backed by airtight evidence, but because they fit a worldview we're comfortable with, or because they explain events in a way that satisfies us emotionally. It's why two people can look at the exact same market data and draw completely opposite conclusions. Their interpretation is shaped by the story they want to believe. During moments of uncertainty, especially in booms and busts, these stories take on even more power. In bull markets, people might convince themselves that this time is different, that rapid growth is permanent, and that risk has somehow disappeared. In downturns, the opposite narrative emerges: everything feels doomed, recovery seems impossible, and fear takes over. The problem is, both extremes are often driven by emotions, not facts. Housel illustrates how humans are wired to seek meaning. When something complex or random happens, like sudden market volatility, we look for a cause, a clear explanation we can hold on to. But complexity often doesn't have simple answers, and randomness doesn't like to be explained. Still, we'll latch onto a story, because uncertainty feels unbearable without one. This is where financial myths, overconfidence, and herd behavior can lead to poor decisions. The takeaway is this: good financial decision-making requires recognizing when you're buying into a story simply because it's comforting. Being aware of your own biases and resisting the urge to turn every event into a neat narrative can help you stay grounded. Sometimes, the most honest answer to, "Why is the market doing this?" is simply, "I don't know." Housel ends by reminding us that the psychology of money isn't about becoming immune to stories, that's impossible, but about understanding their influence and questioning them before letting them dictate our choices. The best investors don't just look at numbers, they look at the narratives behind the numbers and decide whether those stories are worth believing. Chapter 19, All Together Now. After exploring all the different angles of money, from luck and risk, to compounding, to ego, to freedom, Morgan Housel now pulls everything together. This chapter is like stepping back from a giant, detailed painting and finally seeing the whole picture. It's about connecting the dots between all the lessons we've learned so far. Housel begins by reminding us, there's no single formula for wealth, success, or happiness with money. Instead, there are timeless principles that work for most people, in most situations. These aren't rigid rules, but guiding philosophies, ways of thinking that can protect you from costly mistakes and help you take advantage of rare opportunities. Here are the key takeaways he ties together. Save money consistently, not because you have a specific purchase in mind, but because it gives you flexibility, resilience, and the ability to act when life changes. Wealth is as much about what you don't spend as what you earn. Take a long-term view. Compounding is slow at first, but unstoppable over decades. Patience is a superpower in finance. Accept that luck and risk are real, your success will never be 100% the result of hard work, and your failures will never be 100% your fault. This keeps you humble and compassionate toward others. Don't chase someone else's goals, avoid copying the financial decisions of people whose lives, priorities, or risk tolerance are different from yours. Plan for surprises. The world is full of unknowns, so always leave room for error. The safest plan is one that can survive being wrong. The overarching theme is that money is personal. You can take advice from books, experts, and role models, but in the end, your financial plan has to fit you. The purpose of money isn't to impress others, it's to give you the life you want, on your own terms. Housel ends this chapter by saying that the best financial plan is the one you can stick with through good times and bad. Not the one with the highest possible return, but the one that keeps you sleeping peacefully at night. When you put together the lessons from all the previous chapters, humility, patience, realistic expectations, and personal goals, you end up with a strategy that's not only effective, but deeply satisfying. Chapter 20, Confessions. As we near the close of The Psychology of Money, Morgan Housel leaves us with something deeply human, his own financial confessions. It's a reminder that even the guy who spent years studying money's quirks isn't immune to its emotional pull. He doesn't pretend to have found the perfect formula. Instead, he admits he makes decisions that wouldn't pass a spreadsheet's logic test, but do pass his personal peace of mind test. Housel explains that money decisions are never purely mathematical. They're emotional, personal, and tied to our unique life circumstances. What looks wrong to an outsider might be perfectly rational for you, if it aligns with your goals, values, and tolerance for risk. For example, he admits he keeps more cash than most financial planners would recommend. Why? Because having that cushion helps him sleep at night. That emotional comfort is worth more to him than a slightly higher investment return. He also confesses that he invests conservatively, even though history suggests a more aggressive approach might yield better long-term gains. This isn't because he doubts the market, but because he values avoiding stress over squeezing out every last dollar of growth. His money habits are built not to maximize wealth, but to maximize the life he wants to live. The bigger message is this: personal finance is personal. There is no one-size-fits-all approach. It's okay to make decisions based on your personality, fears, and dreams, even if they don't line up with conventional wisdom. The best financial plan is the one you can stick with, through good times and bad. In the end, Housel's confessions pull together all the threads of the book: humility, long-term thinking, independence, and aligning money with what truly matters. He's not offering a perfect blueprint. He's showing us that money, like life, is a constant balancing act between what's ideal on paper and what's sustainable in reality. And the real win isn't having more money, it's having a life that feels rich in every sense of the word.